George. If you've never met him, Matt and I started doing, when I was at my last company stop before I started this company in 2000, I went to work at a company called Harvard Mortgage, and Matt George was one of their key appraisers, I think. And Matt started doing appraisals for me back then. He was already a really seasoned appraiser, and he's the appraiser I trust the most out of all the appraisers that we work with. And when one of the other appraisers that we work with messes something up, I always call Matt and go like, can you look at this and tell me if this is supposed to be this way? Is this right? And I've always given Matt one directive. I said, don't ever get me in trouble with underwriting, and give me every nickel of value that you can give me and the loan will get bought. I don't want a nickel more. Don't ever push the value beyond that. And I think it's because of that, Matt gets that. And because of that, it's just been a great relationship. We literally have never, knock on wood, now we'll have one, but we've literally never had a problem with an investor on an appraisal that Matt did. And his history goes way back. I'll let him fill you in on that. But Matt, thanks a lot for taking the time. Matt actually offered to do this, so it wasn't our idea, it was his. That's what great appraisers do, is they try to anticipate the need. And so this is going to help us a lot. So go ahead, let's get started.
Yeah, I'm glad to be here, everybody. I want to just start, and I know we've got a brief time, and I want to make sure that I utilize your time to the best of my ability. In other words, this presentation today, I want to be there for you. I want to answer the questions that you have. I want to be able to work out scenarios that you're thinking about so that you cannot run into appraisal issues or underwriting issues. I'm going to give you a little bit of background about myself, and it'll be important because I think it's important that whoever you choose as appraisers, and now we are thrown into the pool of appraisers, and I'll tell you a little bit about that. But the reason I want to give you this background is because we are going into some different times, as everybody knows. And we've been in those different times now for 6 months. And if you are not aware of that, then I know you are. That's really not a question, because there's no doubt about that we are in a changing, volatile market. And so it's very essential, important that you are aligned with an appraiser or an appraisal team that understands what's going on. And the reason is because we have underwriters, we have secondary markets, we have the owner of the company that you work for. All of these things come into play. When I started in business, I was a senior in high school. My dad was an appraiser. And so I worked for him all through college, graduated on a Saturday, moved on a Sunday, started working for him on a Monday. And my dad was somebody who had gone 2 years of law school, had been through a lot of stuff, and landed on real estate, and then landed in appraising. And so he had been an appraiser for many years, and I worked under his tutelage for many years in a place called Salina, Kansas. And I'd like a show of hands. Has anybody ever driven through Salina, Kansas going I-70? Yes, okay, a few of you, thank you very much. It's a long drive if you happen to go out east, but it's a great town, about 45,000 people. We were the largest appraisal company in a 15-county radius, and I did everything from single family to farms to commercial properties as well. And so I've been doing appraising for a long, long time. And so many years that I've done it, if you did the math, I've done it over 40 years, but I've done over 20,000 appraisals. And I tell people that, and they go, there's no way. And I go, well, do the math. If you're averaging about 500 appraisals a year, you're going to be about 20,000. And even if you want to just lower it to 15,000, I'm fine with that. I'm still in the top 5% in Colorado in terms of appraisal volume. So I'm not telling you that for any other reason, but to say, hey, listen, I kind of know what I'm doing at this point in time. Let me fix this. And then why I say that, my thing jacks up. All right. So here's what we've got. We've got an appraiser who's got a lot of experience and been down this kind of a lot of things that I've seen. And I will tell you, when I was with my dad, we went back to his town in Newcastle, Indiana, where he grew up. Anybody ever been in Indiana or Newcastle, Indiana before? So you kind of have an idea. Well, it's a great Midwest state, Midwest vibe, kind of like what I feel like Colorado, because I feel it's real life people that kind of at least talk about what's going on. And so in that vein, we're talking about where my dad was taking me to his old home. And when we were going to his place where he lived, he would drove up this hill and he would go down this hill. And this is in Newcastle. And it was, you know, a town of like 30 or 35,000, but he's going around these places and around curves and around streets and all these different angles that he was going. And I said, Dad, you know, here you taking 5 or 6 turns and we turn up this, you didn't have navigation or anything like that. You know, how'd you know where you were going? Because it's been 20 years. And my dad responded to me, I've been here before. I like that because in terms of what's going on in the market today, Dave and I, and many of you, we've been here before. And that's an important thing when you're talking to your clients, to let them know, hey, guess what? We know that it's an unsettled market. We know that things are going on, but we have been here before and we will be able to walk you through this journey. And it's important that people feel like we are coming alongside them. And so today we're going to be talking about trends. We're going to be talking about what's going on with different markets and different areas. And we're going to just simply say to our clients that are right now emotionally panicked. Would you agree with that in some extent? Yes or no? Okay, yes. So if people that are emotionally panicked, I'm going to coin a phrase for you that my 8-year-old grandson helped me come up with, and it's called emotication. Emotication is my word for the day. And so you're going, that's a stupid word, but that's okay. I want you to just bear with me what it is. Emotication is basically education for the emotionally impaired. So what I'm really saying is that there's so much emotion going on and people are responding to emotion. They need to be educated. All right. And that's what sets you apart as loan officers, is that you have chosen this profession because you want to educate your clients as to what they need to do, where they need to go, how they can navigate these interest rates that are not something that they're used to. And so it's going to take a little bit of educating them because they're used to a $700,000 property 6 months ago. They were riding that wave. They were having a great time on that wave. Hey, this is great. This is a lot of fun. But now that $700,000 value is $600,000. And they're like, what is going on? I can't believe the waves that I'm trying to get on here. And this just can't be right. And so what happens is that they get stuck on that wave that had gone up into a situation, not realizing that, guess what? Things change. And if we don't adapt to that change, we're not going to survive. And that's just life. And so I'm giving that introduction, that background to understand that the appraisal world is no different than your world, in that we are analyzing and studying change, and we are doing it in the scope of the appraisal process. We're doing that into the scope of what an underwriter looks at and what third-party investors look at. And with that said, it's important that we kind of talk about trends. So everybody with me so far on what we're doing?
Yep.
Okay. Let's talk about macro analysis, and then we're going to talk about micro analysis. And we'll do this over the next 12 minutes, if that's all right.
Go.
All right. First of all, have any of you done any presentations to your clients or done any kind of videos or any kind of education programs for your clients, for your customers, that would let them know what's going on in terms of today's trending?
Yes, no, I don't know. I don't know what you guys are doing.
That's why we're here, Matt. We're trying to learn from the best.
Yeah, there you go. Thank you very much. I would ask Giuseppe. Good morning, Giuseppe.
Morning. Yes, lots of videos. I don't know that I've dived in on appraisal and values. The way I've been explaining it, hope it's right, is just that, you know, in talking to some agents, a lot of agents are wondering where to set listing prices. And it seems like more than one agent are going back to like fall of last year, like a year ago, because the first half of this year, homes were getting bid up 10 to 20%, and then their neighbor would list, and that would get bid up 10%, and their neighbor would list. But most of those were covering appraisal gaps, so the values weren't really there. But now the people that are late to the game trying to sell, that needs to be explained to them.
Right. And so you do that with your videos, correct?
Yeah.
And so that is part of that emotication. I would suggest to all of you, that is a tool that Giuseppe is using, and that is a wonderful tool that each of us can do to our clients, to our customers. Even the reason I wanted to get together with all of you is to say, listen, appraisers have got major obstacles that we've had happen to us over the past year that have literally changed our industry. And so we are in that state where we need to we're all on the same team, and we need to just come alongside you and say, hey, listen, we've got to let everybody know what's going on and why it's going on, and why is this appraiser having a problem with this particular loan that they're working on. But Giuseppe, I've seen several of his videos, and what he does, he's just telling his clients, educating his clients, his customers, hey, this is what's going on. No need to panic. We're on top of it. He gives that assurance of, hey, we've been here before. And you're going to hear me repeat that phrase again and again, because there's no substitute in my mind for experience. When I go into surgery, I don't want somebody that's still in med school. Are you following me on that?
Yeah. No,
I'm sorry, that's not giving me a warm fuzzy when you're doing some major surgery on me. I don't like that. And yes, you might have some working knowledge of the body, but I want somebody who's been around a few years so that they can understand if there's any kind of problems that come up in more of a difficult time. Guess what, you guys, we're in a difficult time. So this is something that some people are going for faster, better, cheaper. And I'm telling you, that's what you get. And it's the same thing you work with in your industry. People can go to the website and get a realtor or get a loan officer or even a value for pretty close to nothing. But there's a difference between service and no service. There's a difference between somebody keeping you alive and not. And so I would like to think that we have all joined together as a team of saying, hey, we are different than those half service or partial service type of entities. And we do that by providing knowledge and walking people through it by saying, hey, we've been through this. We've been here before. And in my career, I've been through 3 what I call crashes. But if you're a realtor or you're a loan officer, you call them corrections. I've been through 3 of those, and I can tell you that we've come out through the other side. I will even let you know that in 2008, when things crashed, and I was president of the Appraisal Institute, and we did multiple things trying to make things go well for appraisers, we lost in Colorado 30% of the appraisal workforce. That's a pretty big chunk, and I'm only suggesting that because people couldn't survive as things went south. We are now faced with something going to be similar to that for appraisers, and it's called appraisal waivers. Appraisal waivers has come down the path, and that has said, hey, guess what? We don't need you appraisers. Most of these deals, we can do them internally with AVMs, that data that we stole from you, that we've mined from you for years, which is another topic. But we are now going to be able to say, hey, we're going to take that data, we're going to come up with a reasonable number. We've got an AVM, desktop underwriting kicks it out, we're good. Well, that's taken away about 40% of an appraiser's income. And I'm not sure about how you guys, I know you guys are all independently wealthy and money is no issue, but 40% is a huge deal for most appraisers who are in the trenches. So just kind of giving you that heads up. So then we have the appraisal waivers, and we have appraisers that are just trying to kind of keep things rolling. But the appraisals that we are getting now are the ones that aren't under the waivers. They're the ones that are difficult. They're the ones that are challenging. They're the ones that have more requirements from underwriters. And so you're going to get an appraisal back now that maybe has some stips, and you're going, hey, what's up? What's wrong with the appraiser? And I'm guaranteeing you there's nothing wrong with the appraiser. The appraiser has so many issues that they have to go with in a short supply market, I might add, which makes comps incredibly difficult. So we're trying to do all of that kind of data, and it's very challenging. So with that said, what we do is we try to make sure that we paint a picture with trends, both on a macro basis and a micro basis, And that's where I was kind of going with all of this, giving you a little background of what we're faced with as appraisers. Macro analysis, has anybody seen, just in terms of when you see general trending data, and that's just, we're going to start like regionally, obviously national trends, you have regional trends, and you have local trends, okay? And then we have micro trends, which are going to be your neighborhood, your market area that you're looking at. So the appraisers got to kind of go with this big funnel, and then they work their way down to where your location, where your market area is. But we're starting with not national, but regional, and then we kind of know what's going on with local. So has anybody seen what the realtors put out? It's called something like Fast Tracks or something like that. We'll tell you what the median price was a year ago and what the median price is today. Anybody seen that type of data?
Sure.
Right. And do you use it in your analysis and you're communicating?
Do we?
Yes.
I don't think we do. I'd have to ask, but I don't think that's something that we would necessarily refer to, because we're always at the mercy of the contract that was written. And they wrote the contract, the offer got accepted, here we are. Right. So we have to always work within, you know what we're up against. We have to work
Yes.
within the confines of what the two real estate agents, the buyer and the seller, all think the value is.
Okay.
We don't really get to influence that a lot. That's your job.
Right. So what we get in this situation with macro analysis is just kind of telling them what the general market is doing. And if they see that the median price in Jeff County or the median price in Highlands Ranch is declining, that's a red flag to underwriters. They're going to know that. They're going to see all that general information. So appraisers are going to at least try to work through that. When we narrow that to our individual market, and I'm going to kind of go into the micro analysis here as we start doing that. Has anybody looked at what the realtors have on their MLS, RE Colorado, called the 1004 MC?
No.
Okay. I have a 2-hour class, and we're not doing this today, but I walk people through this 1004 MC, which is a great tool for realtors, telling them what's going on in their individual market. And so you can do the market area, and then we can talk about how it relates to the property. But it goes over the days on the market, the days of absorption. Are we talking about a 3-month? Are we talking about 4 to 6 month that housing supply is? That supply is critical to understand what's going on in terms of trending data. All right. It talks about list to sale price ratios. It gives all these kind of data that's important for us to figure out what's really happening in that specific market. Okay, so what I'm going with that is every appraiser has that. I was helpful with RE Colorado making that part of their something that they get on. Everybody, realtor can have that every time they do a listing. And so I think it gives you a leg up. And if you want to talk to your realtors about that when they're marketing in a changing market, when the market was going crazy and up, nobody cared. As the market's leveling and correcting itself, people care. More importantly, and I'm going to kind of wrap this up in terms of trending with this micro analysis. When I do that 1004 MC and we see three sections of the market, we look at what happened 7 to 12 months ago. Okay, then we look at what happened 4 to 6 months ago, and then we look at what happened 0 to 3 months, today's market, right? We're looking at the median price of those 3 times. So generally what you'll see is that 7 to 12 months ago, the market, the median price was 700,000. 4 to 6 months, the market was 800,000. And then now 0 to 3 months, the market has gone down, back down to 700,000. Are you with me on that?
Yep.
Is that a declining market?
Yep.
Everyone?
I think, is it?
Well, here's where we run into problems. If it becomes a declining market, and if you're an appraiser, you got to kind of figure this out. If it's a declining market, the appraiser has to have 2 listings as comps. And those 2 listings have to support the value that you have. What's happening right now is some of the listings that are going on the market, people are just unloading their houses. That's pushing the values down. That's having an impact then on your appraised value.
So listings, not sold comps, just listings.
In addition to your 3 closed comps,
Okay.
you have to have 2 more listings in a declining market.
Okay.
welcome to the problem.
Yeah.
It's a big deal. And so as appraisers, you're trying to navigate, do we have a declining market? Now, I will tell you my secret. What I do in terms of, and this isn't anything wrong or anything like that, but my secret is to go further, to explain to the underwriter, to explain to the lender, here's what we really have. We have a market that, because most of the people, when you're looking at trends, they're looking at annual trends. And the fact is that if you're going to just look at only 3 months, there's too few of sales, too few of data points to just really tell you that we're in complete panic mode. And sometimes you'll have sales that really are not market transaction. You just have somebody says, I had to move. And so it was a distressed sale. If you're a short supply market, distressed sales, that's problematic. So here's how I do it. I go further. I look at the annual trending data, not just 0 to 3 and 4 to 6, because if there's not enough sampling, I look at the big picture. And this is how I explain it. Yes, the market has declined from 4 to 6, but it has leveled or stabilized from where it was 7 to 12. And now, obviously, I can only say that if it's true, because appraisers are going to tell you what's only true. I'm not going to manipulate. I'm not going to make stuff up. I'm just going to do what's true. But the fact is that is accurate, that the overall market has leveled off, is stable. Here's how you can be okay, is if your listings still support your value. If your listings do not support your value, you will always be lower, always. Because nobody's going to pay more for your house if they can buy it on the street for less.
Right.
Principle of substitution, appraising 101, basics. So if you don't understand that, or you can't convey that to your realtor or anybody else, they're not going to buy into logic. They're not going to understand what facts are. And I've been down that road with realtors before where they said, well, market value is what anybody's willing to pay. That's their definition of market value. Unfortunately, that's not the definition that Fannie Mae, Freddie Mac, FHA, VA had. Because their definition is market value is the most probable price that a knowledgeable buyer will pay, with 7 different criteria that are impacting the market, like financing not being an impact to value. Oh, well, guess what? People are paying $15,000 on seller concessions right now. Is that impacting the value of that property?
Yes.
Yeah, because somebody that paid $600,000 for that house with $15,000 just buying the points down, we all know what that is. It's seller cost, whatever you're going to say. Guess what? That seller really took $585. You say,
And then does 585 become the new value then?
Thank you very much.
And explain to people why that's important.
Well, if you're looking at one of the definitions of market value is cash equivalency. And so I realized that appraisers aren't supposed to make a dollar for dollar adjustment on financing or anything like that. I get all of that. So people that might be listening to this or appraisers are going, hey, you're not supposed to make dollar for dollar. I understand that. But the issue is if the market is doing dollar for dollar, then you're doing dollar for dollar. And if you are on a cash equivalency basis, then guess what? They took $585 for that property. That's what the seller ended up taking. Now, we're not talking about normal seller concessions, but 15 grand, 20 grand to buy down a loan, that is not normal. 3 grand, 4 grand, 5 grand, that's normal. We all know that. So I'm not telling you something you don't know. I'm just saying, be aware that if my comps all have 15 grand across the board, that is problematic. And I'm going to just throw this into the mix just quickly. And that is, if you remember 08, there's a place called Green Valley Ranch. There's a great area, a lot of new builds of beautiful homes. They were nice homes, well-built, good quality builders. In 08, their foreclosure rate, that came about, 70%. 70. Put that in perspective. Right now, it's less than 1. So I'm just putting this into perspective. A vast majority of those sales, vast majority, they had high seller concessions that the builders were taking. The builders were taking high seller concessions. I'm just telling you that's a fact of something that was consistent among all of those foreclosures that happened, is that almost every one of them had high seller concessions. And they called them builder incentives, and you can call them whatever you want. but the builder was trying to maximize as much money as they could. We all know that. That's how they played that game. Well, guess what? People went south. So I think I'll stop there, Dave. I mean, obviously, we could talk for a long time, but I want to open it up to questions because your time is valuable. And anybody, you guys want to call me or talk to me about anything at any time, you guys have my number, you got my cell number, you got my email. You reach out to me anytime you want. But here's the deal. I'm just telling you this just so you know. In my career, I'm planning on going to be here for several more years. I like what I do, and so I'm going to continue to do it as people want to use me. I have narrowed my loan lender work to only 3 people, and Dave's at the very top of my list. So I'm telling you that just so you know, I could work with anybody I want to it here, and I don't, because I choose you guys because of Dave. So you've aligned yourself with somebody that I appreciate his integrity, his work ethic. He's never, ever, ever asked me to do anything wrong or inappropriate. He's always said, hey, do the best you can and give me as much as you can. But he's never, ever said, hey, I'm not going to give you any more work if you don't come in at this number. Never. You're talking about somebody who has, and you know him, you guys work with him, but that's why I've aligned myself with him for years. And that's why I'm going to continue with that. That's, to me, that's valuable in terms of relationship. So with that said, if you want to call me, you got a free ticket with Dave. So
thank you. I really appreciate those very kind words, and it makes me feel really good. So thank you. But what's a message that these guys need to hear, or what? And I guess that a better question would be maybe for one of the LOs or several of the LOs to raise your hand, and just is what would help you today? What's a message that you need to be able to get out to either your agents or your buyers that would help you, given the reality of what's coming? Because what's coming, if this continues, if this market continues like this, and we start to see, and we do more and more of because we're out pitching, right? Seller concessions, we're pitching them.
right.
We're telling the buyer that they can get a seller concession. And we're not actually, now as I'm listening to this, I'm realizing like, oh yeah, that was a pain in the ass in 2008 and 9. And it got really, Giuseppe remembers, it just got clunky, and it was always challenging. And so what questions do you guys have that he can answer? Because the knowledge is, and then I have an ask after this, but Giuseppe, Casey, Christine, Ryan, anybody with and not that, and any of you guys, new people too, I'm not trying to limit you, but does anybody have anything that they want to ask, or that would help with your agents or your buyers?
Yeah, well, thank you, Matt, for being on today. This is super valuable information. I've got a question just in regards to the 2 listings in a declining market, right? Because I've always told agents that really it's more on the closed homes rather than any listings. So what we're guiding them to now is they do actually need to take into account listing value and how that's going to impact the appraisal. Is that accurate?
100%.
Yeah.
Principle of substitution. If you can buy for less, it's worth less.
Yep. Okay. This is great. Awesome. Thank you.
I'll give you an example real quick, as I had a refi with you guys that I think the borrower wanted the value to be worth more than what my appraisal was. And
that's weird. That never happens. That's so weird that you bring that up. Go ahead. Keep going. I'm sorry.
So, well, what was funny about it, I mean, to me, it was like, I knew he wanted it more. I knew it. And so it's like, the reason was he started out, he had the house on the market within the past 90 days. In the past 30 days, he had it on the market. So he'd started like at 630, okay? And he worked his way down to 520, okay? Now he wants it worth 540, okay, or 550. Well, guess what? If it didn't sell for 520, that was that price. Not only is that just a done deal, it's like, dude, there's no way in the world I could come in at 540 ever, because you just had it on the market. And guess what? The market told you it wasn't worth 540. Yeah,
Well, the market told him it wasn't worth 520 either, right? Because he didn't sell it at 520.
Well, yeah, but I still came in at 520, and I'll tell you why. Part of the problem was, and this is where there really becomes the rub, he had it listed too high. If he would have started at 570, this is where I think you really add value added to your realtors. Listen, you start out at 620, you're screwing yourself 30, 40 grand. You're literally screwing yourself by overlisting it, being greedy in this market. You cannot afford to be greedy in this market. Those days are done. If you're still living in that market, you are living in the past, and good luck with that. But I'm not living in the past. I'm saying this is what's happening today. And the market's going out there going, what can I buy? And when I talk to people, they say, oh, I'm going to wait it out. What? Wait it out 6 months ago, that would have never come across somebody's lips, because if they would have waited it out, they'd still be waiting, which many of them still are. Bottom line is that 540, it was not 540 because he ended at 520. I had data all day long to support that, but you just got to, again, yes, I could have maybe been lower than that, but 520 was all right in that situation. But point being, I couldn't be at 540 ever.
Casey, do you have something?
I do. And again, thanks, Matt. I know you and I have talked a couple times on the phone over the years, but my question really is just kind of something that we can help give advice to our clients on when they're looking. What areas are you seeing more drop in values versus what areas around Denver? Because I know there's still a few pockets that are actually still going at value or even above list price.
Yeah,
what
Matt, we're still
do you see the
hearing.
biggest spread?
Yeah, we've heard. I heard about John had a client out making offers this weekend and lost out that and it got bid up over asking, and a cash offer over the asking price, won the day. And so what are the trends? I guess, what are the micro markets, or what are the price? What maybe it's not necessarily geographic, but price range that we ought to be aware of?
Right.
And I'm curious geographic too, like if there's any pockets where you see, hey, these are kind of outliers where, hey, they may hold high value or they may be way less desirable in certain areas where more deals can be had, I guess, for the borrowers.
Denver is the greatest area in the world, and every other city sucks. That's my trending analysis. Hey, really, it does vary from area to area. And Casey, and I'm happy to help. But we would have to do that. Just call me or email, and I'll walk you through how to find that out on RE Colorado to see what those trends are doing.
Okay.
Because
I'd be interested in that.
And it's important, and especially because lately there have been things about appraisal bias, where appraisers are biased about a certain area, or they think that we're redlining areas, something like that. So really your question, I know where you were going with it, was there was no way implying that we would pick areas, but we are especially more sensitive to it now as an industry, which we all should have been in no matter what. So I'll just let the data speak for itself, but there's no area that I would ever just say, yeah, go here or go there, don't go there, because that is implied redlining, and all of us are completely against that. I'll throw out too something interesting. I was in a class with Dora just this week, just a few days ago anyway. And there were people that talked about, and the state talked about, because there's huge stuff about appraisers being racially biased. I don't know if you read about that, where an appraiser goes in a property and it was one person had.
Oh yeah, I've heard of this.
One person of color was there, and the appraiser comes in with, and another appraiser comes in, and they said, oh, well, that they appraised it lower when they took all of the pictures and things like that away. And here's what the facts are. You're not going to hear this in the media because it doesn't sell, but the facts are, Dora said, we've had a few of complaints that have come out, a handful, and they were unfounded. And then there were major lenders that were there, top lenders throughout the nation that were there, and they're dealing locally. And they said, yeah, we've had some that have come up, and it didn't amount to anything. It was unfounded, was the term they were used, unfounded. And so my problem in my industry is that if you redline, it's a red flag. I'm sorry, Casey, that really wasn't your question, but simply to suggest anybody who's listening that think appraisers do that, you're nuts, because there'd be no reason, no benefit for us ever to redline. There's no benefit. We just do our job and we move on.
When you mentioned Denver's great and every other, I know you're kidding, but Denver historically has held its value when all the other markets don't. Denver's always been the one where when the suburban markets are trending down, Denver doesn't trend down. Denver stays flat is what I remember. Is it still like, are you seeing those kinds of markets right now?
What happened in 08, Dave, is that we did much better than the other cities, many other cities. So yes, you're spot on. We still took hits, but we did much better. Casey, to really answer your question, I'll get the one word that your realtors, when you're advising them, and that is supply. The reason people are bidding up in those situations, they can't buy it for cheaper. And that's my whole point, is why I think it's a stable level market from where it was 7 to 12 months ago. That's exactly my point. Supply to me is the buzzword. If you really want to look at whether markets are going up or down, you'll go to some areas in some parts of town, and there are 4 or 5 or 6 or 7 houses in that area. Guess what? Those are the markets that are getting hit. And the other markets you're talking about, there's still a short supply, like less than 3 months, and that's how appraisers gauge it. Less than 3 months is a short supply. 4 to 6 is normal. Over 6 is a high supply. But under 3 month supply, that would be an indicator. So I just tell them, go back, check your supply and see what's going on to see if you really need to buy that house. Because if you don't, you're not getting it bought.
And just quickly share with everybody how they determine that it's 3 months or less of a supply, the math.
No, that's on that 1004 MC, because we do that search of the market area. We draw a map around it. And again, I can walk you guys through that, but I'll figure out what your market area is that you're looking at. And then I just plug in the data, show me all the sales in the past year. And then it breaks it out into those trending things. And it'll tell me 0 to 3 months, what's on the market and what the housing supply is. So they do it mathematically, what the absorption rate is, but it's a great tool. I mean, it'll set you above everybody else. So.
And do you have an opinion of what you think's going to happen if the market, because you're aware of where interest rates go up and down, or do you have an opinion of what you think could happen? And this is, I'm asking this for a very specific reason. If rates dropped again back, because we're hearing, we follow some people who think rates are going to be below 5 in the second quarter next year. What do you think will happen to housing if that were to occur?
One of the reasons why, and go back to Casey's question, which I think is really good, is that people are willing to buy it because of the short supply, realizing exactly what you're saying, that they're going to refi in a year or 9 months or whatever it is at a lower rate, and they don't want to lose that house. So Casey, that's why that market is staying good. Still, they have the short supply, and even if they have an increased supply and they really want that house, they're paying for it. If they can afford it, they're paying for it because they don't want to lose it. So with that said, they'll do it going, hey, I don't care, because in 9 months, I'm going to refi. Now, keep in mind, I don't know how long a period of time you guys have before they refi, how that's going to impact your commissions. But I just say that that's in some people's minds, and Dave, I don't know. I don't have any idea.
Okay. And then Kim had a question for you. Matt, are you seeing many declining markets? We've seen some low appraisals, but not declining markets so far.
Yes, definitely seen declining markets, some of them that were lower than they were a year ago. Absolutely.
And what are they?
Well, just different appraisals that I've done.
Pick one, pick a market.
No, not saying that.
I was so close.
It varies from property to property, but again, the point is I really think, from what I've read, Dave, you have the heartbeat of that, but I've read that the rates won't go lower than 5. And that's, but you have the heart of it. You know that better than I do, but it's still better than 7. And so when those rates go back into that range, I think that the market will definitely pick up. Most people have defined today's market like a spigot that just got shut off. And that in the real estate world, that market real estate, they got to change that. But they did it because inflation was 8%. So they're trying to balance.
Well, and 15 and 20% appreciation is just completely unsustainable.
Unsustainable.
Period. Like, it had to stop. And so what the Fed's done did have the intended effect of it, put a stop to that appreciation. and which guys, we would have all been out of business. If prices keep going up 20% every year, no one can buy a house. Like no one can buy a house. And that just doesn't work. So this needed to happen. Does anybody else have anything? I have one more question for him. Does anybody else have anything that they want to ask specifically? No. So how does what we mentioned, one of the things that we were interested in discussing with you was perhaps a webinar that we could do with your expertise for real estate agents. Is there, and I guess this is something that you and I can talk about offline, but that would be something that we'd be interested in discussing. So I'll follow up with you myself and just see, because I know that real estate agents right now would love to have that value. And if we could do it in a webinar format like this, we could probably get a ton of eyeballs on it and really try to add some value to the realtors and make our jobs easier and theirs and yours. So
I have a class, Dave, that's a 2-hour class, but we could reduce it to whatever, called How to List Your Price in a Changing Market.
right on. All right. I will follow up with you. It's 2 hours.
You can be whatever you want.
Is it a CE? Is it CE?
It was CE, and I didn't, but after, with COVID, I quit doing all of that stuff just because I was doing other stuff. So I haven't, no, it's not, to answer that. Probably
Okay.
could be, because it was then.
Yeah, it could be. And then Dennis, new LO for us, can we attend your 104, and what does it say? Can we attend that class that you do on the 1004?
Are you talking to me?
Yes,
Yeah, that's part of that class.
that's part of the 2-hour class.
Yeah.
Oh, okay. All right, good to know. I will get with you after this.
Great.
Anything else, anyone, everyone? Holly? Cam?
I think my only question was, I've heard or I've seen maybe in the past that condos and attached homes a lot of times are kind of the first to feel that impact. Is that true, Matt, or is that a fable?
That's very true. I'm just speaking experientially.
Okay.
I mean, so I can't back it up factually, but I remember all 3 of them that they were one of the first to be hit.
And just because of the desire, we sell more single family homes than we do condos, right? So there's just a higher demand it's just demand.
Well, and we do a lot of high LTV, like a lot of first time home buyers buying those, starter townhomes and condos. And, they're the ones that'll be impacted if they, have to sell fairly quickly and those values have gone down. That's where we see those problems start, right?
Right.
And you can buy a house then for a lower price. So why would you want a condo? Would be my thinking.
Great point.
Yeah.
All right, Matt, this is great. Thank you very much. This is a very nuanced part of our business that you do need to have you don't have to become as expert at this as Matt, certainly, but understanding what goes into this because you're on the front lines of this. So understanding how values work. If you've never taken an appraisal and just studied it and you owe yourself, you should do it and study the appraisal and put your questions together and get them answered, because just being able to add that value to the client and to the real estate agents when things don't go the way that they want them to is a big deal. So Matt, thank you. This was great.